This is the Financial Sense News Hour with the president of PFS Group, Jim Poplava. Since 1982, PFS Group has offered asset management and educational resources that have helped investors build, maintain, and preserve their wealth. Now, here's the Financial Sense News team, Jim Poplava and John Leffler.
There is no doubt this has been a tumultuous year. We weathered the Arab Spring's effect on oil and gas prices, the Japanese earthquake and tsunami's effect on supply chains, the extraordinary economic uncertainty in Europe, and recently markets around the globe have taken a bumpy ride.
Do our leaders in Washington understand that we've lost $2 trillion in the stock market in just over 2 weeks?
Now growing worries that Italy and Spain, big economies, might not be able to repay their debts.
I think investors in general are just very worried that we're headed for a recession, and they want to get out while the getting's good.
I wish this was a recession, because if it was, we know how that plays out. You go down and you come back up. But we're in something very different, something we haven't seen before, kind of a long-lasting, debt-unwinding malaise.
When I said change we can believe in, I didn't say change we can believe in tomorrow, not change we can believe in next week. We knew this was going to take time, and we knew the road ahead was going to be difficult, that the climb was going to be steep. I have to admit, I didn't know how steep the climb was going to be.
We don't like to say the word fear, but certainly fear is a factor in here.
High anxiety time.
You know, I really think I'm losing it. Let's face it. Everything coming out of Washington is so confusing and anxious. Both sides claim they won something in the debt ceiling debate, but their constituents think their side lost. So they should be happy about losing while winning something. Boy, that's confusing. Kind of leaves me feeling a little anxious. Then we spent a lot of stimulus money and got nothing back for it except $8 trillion further in debt. But they say we had to do that to keep things from getting worse, so things could get better even though things are getting worse. There we go again. That anxious anxiety. Every time things start falling apart, they say they're not falling apart, but then claim they're fixing this stuff, which they said wasn't falling apart, so it doesn't fall apart anymore, which it then proceeds to do. There's that anxious feeling in my stomach again. Well, I've got two options to handle my high anxiety. Expensive psychotherapy. Oh, here it is. The off switch to my TV remote. Yes, now that's much better. I'm not anxious anymore.
It's the repeat, except in 2008, we were having a crisis of specific financial firms, and specific financial firms were going bankrupt. Right now, we have entire countries on the verge of bankruptcy. What do you think is worse? A company like Countrywide Real Estate going bankrupt, or a country like Greece and Spain and Portugal going bankrupt? So this crisis has the potential of being worse than the last one.
Yeah, because the last one, Bert, we were talking about companies, we were talking about financial institutions, but, big government stepped in behind. We had TARP, we had the stimulus, we had the bailouts of the automobile companies, AIG, you name it, the big companies were bailed out by government. But when governments go under, who bails out the governments?
That's exactly right. And now, not only that, but investors have now found out in the last 2 years, with all of this fantastic stimulus that has been put into the system everywhere, in China, in the U.S., in Europe, it was all for nothing. All we got was a 2-year cyclical bull market, 2-year bounce basically, and a secular bear market. A secular means long term. We are in a bear market right now that actually started, but in 2007 is where it started in our measure. There's some indications that it actually was in 2000, and then Greenspan reinflated that bubble, but it was just a credit bubble. It was not economic. So right now, we can say that this is the worst situation. Investors have found out that government is impotent with its stimuli, and that the central banks are impotent with their rescue missions. All of that money, China, the amount of money they fabricated and put into the system, the government, is 3 times greater per GDP than the U.S. Federal Reserve stimulus. So now everybody knows, okay, the stimulus from the central bank doesn't work. The stimulus from fiscal policy doesn't work. So therefore, there's nothing that can work. Investors will soon realize that. And I've been saying that for the last 3 months. On May 9th, our issue of the Wellington Letter, the headline was, Return of the Double Dip. We said we are in a recession right now. And when finally the money managers realized that, if you deduct the actual rate of inflation from the nominal GDP, you now have a very strong contraction of the economy. The only reason it's not showing up in the statistics is because they're factoring in the wrong deflator. The inflation adjustment that they used was 1.8%. If you think inflation is 1.8%, you better go shopping in the supermarket. So they had the wrong inflation adjustment. So if we have a correct inflation adjustment, we are now in a serious recession, a contraction.
Yeah, the surprising thing is economists were really surprised last week when we reported the first pass of second quarter GDP, and it came in less than 1.3%, which shocked a lot of economists. But what I thought was buried in the back pages, which was even more significant, was the fact that the final revision of first quarter GDP came in at 0.4%.
Exactly. Yeah, and what they also do is they annualize the quarterly growth numbers. If they did not analyze and did a chain weighted, then the growth in the first half is actually less than 0.5%. Now, does Wall Street tell you that?
Yeah, and what is amazing, you still have the talking heads on television and both, not only on Wall Street, but you have it in Washington, where they're talking about a second half stronger growth rate. And they cite that, the stuff that happened in the Middle East, that was just a temporary setback. That little thing that happened in Japan with that earthquake, that was just a setback. And the price of oil at $90-something, that was a setback. And so these were just temporary. And now that they're working themselves out, they're still predicting, Bert, numbers in the 3% range, and I've seen 3.5% for the second half of the year. That means we would have to be growing as fast as China.
Jim, in my book, Financial Apocalypse, which, by the way, is available on Amazon, it gives this week-by-week account of 2008 and how all of these Wall Street analysts on national TV said all of this garbage, the same words. It's just a soft patch, and it's just a pullback in the market. Today, even they said it's a pullback. Some even were courageous enough to call it a correction. But they all said it's not a bear market. My God, why don't they spend a few months and learn some technical analysis? You look at these charts, and we are now in a huge bear market. You have to know what to look for. Don't look at the capitalization weighted indices like the S&P. You have to look at something like the Value Line Index, or you take a look at a very economically sensitive index like the Dow Jones Transports. You take a look at those charts, and they make you sick if you're long. If you're short, you just have to smile. These are very, very serious declines, and I think there's a good chance of seeing the March 2009 lows again. And perhaps even penetrate them. Now, I have to point out, Jim, I'm not a perma bull and I'm not a perma bear. I'm bullish in bull markets and I'm bearish in bear markets. And this is a bear market, and this is the grandfather of all bear markets.
I want to move on to something that's in a bull market, and let's talk about precious metals on the day that you and I are speaking, which is a Thursday. Gold hit a all-time record, and of course in after hours it came down. But let's talk about gold and silver, because if you notice, Bert, I think it comes with $100 increments, but every time, when gold hit 1,400, it's in a bubble. When it hit 1,500, it's in a bubble. 1,600, it's in a bubble. And we're almost at 1,700. And silver is, of course, down. They just increased margin requirements. It would almost appear they can't control gold and they're trying to control silver. But what's your take on the metals markets? Because this is the 11th year in a row that we've seen silver prices, even with this pullback on Thursday, is up 28.5%. Gold is up 16%, and people are calling this a bubble. All you have to do is look at what they're doing in Washington and the rest of the world, and you could almost see gold prices going higher.
Yeah. Well, Jim, if they value gold right now the way they valued it at the Bretton Woods Agreement, which was, about 50 years ago, then gold, which was basically dividing it by the monetary base, then gold right now would be over $9,000 an ounce. Okay? So that's where the real price of gold should be if they use the same valuation as at that time. We will always have sharp pullbacks in the precious metals because government does not want people to think that gold is money, that gold is an alternative. Congressman Ron Paul asked Ben Bernanke, do you consider gold to be money? And Bernanke said, no. And he's so wrong. Gold is the only real money. Currency in your pocket is just a piece of paper with some ink on it. And, there used to be a joke years ago, and I think it's probably more true today than ever, and that is government is the only entity that can take a piece of paper that has some value, put some ink on it, and make it worthless. And that's where we've come. So you're going to have a pullback now in the precious metals because every time when the metals get too strong, they raise margin requirements for the futures contracts. They did that in May with silver. They raised the margin requirement 8 times in 2 weeks. They basically tried to kill all the speculators, and silver just plunged. And so they're going to do this again now, probably with gold, probably within the next few days. And then you're going to have a big juicy correction in the precious metals complex. You could see this yesterday in the markets already, that this was starting. Word had leaked, in my opinion, that they were going to raise margin requirements. So you're going to have a big juicy pullback. The key then is that on such a pullback, that at the bottom, when your technicals say this is the bottom of the pullback or the plunge, that you can buy. Because anything that you buy during a big sell-off like that will be worth a lot more in a year or two.
If they try to control this, or let's say limit it, you mentioned if we went back to the way they used to evaluate gold right around Bretton Woods, we'd be looking at $9,000 gold. And it seems like, Bert, that they're trying to steer people away from it because the higher the price of gold goes, that's really a reflection of a lack of confidence in government.
Yeah.
And the more that goes up, the more people feel or distrust government. So it seems like the powers that be would try everything they can to limit its rise. But, Bert, I don't think they can. I've never seen demand for gold in the same way that we're seeing today, where you have a situation where private ownership of gold exceeds the ownership of central banks. That's a significant change.
Yes, and Jim, in the last big bull market in the late 1970s, it was basically U.S. demand that was driving the gold price up to $800 an ounce. Now there's worldwide demand. In fact, U.S. demand is a factor of the whole demand. I know people that are in the precious metals sales business. They say demand in the U.S. is very low now. So it's basically the big demand from abroad that's causing this. And China is a big buyer. All the developed countries, we heard it yesterday, Korea, etc., they're all adding big ways to gold. And they're going to find there's just a shortage of gold. They're running out of big sellers of gold. The central banks are no longer selling, whereas for the last 20 years they were selling. So there's going to be a huge shortage of gold, and gold is going to be the only store of value. We always used to use that term years ago, store of value. Paper money will not keep your wealth safe. And, of course, government will be on the other end trying to discourage you from that.
Bert, as we close, you've written an excellent book called Financial Apocalypse that gives readers some insight into the way you think and how you've made the forecasts that have unfolded. Tell our listeners about that and how they could get a copy, if you would.
Yeah, actually, the simplest is just go to Amazon.com, and you can order it there. It's Financial Apocalypse by Bert Dohmen. There's another book that has kind of a similar title, so be sure to get the one by Bert Dohmen. Or if you want to read about the book, and there's also a blog on the site, there's a website, which is just my name, Bert Dohmen, DOHMEN.com, BertDohmen.com.